Hey everyone, and welcome back. So today, we're going to decode a really weird day on Wall Street. You had one major index hitting an all-time record high, while another one, stuffed with the biggest tech companies in the world, just took a nosedive. What in the world was going on?
And that, right there, is the big puzzle. I mean, on the surface, it makes absolutely no sense, right? The Dow Jones, this basket of 30 huge American companies, was popping champagne. But at the same time, the Nasdaq, home to all the tech giants, was deep in the red. It's a classic mixed message from the market, and today we're going to find out exactly why.
I mean, just look at this. The difference is so stark. You've got this little splash of green for the Dow, which, hey, a record is a record. But then you have this sea of red for the S&P 500 and especially for the Nasdaq. This wasn't a case of the whole market moving together. This was a market that was completely split right down the middle.
So where's the answer? What's the clue? Well, you're not going to find it in some blockbuster earnings report or a big tech breakthrough. No, the clue is actually hidden in a single, surprisingly weak piece of economic data that dropped that morning. And it set off a chain reaction that just ripped through the entire market.
And this is the number that turned everything on its head. Zero. That's right, 0% growth in retail sales for December. Now, economists, they were expecting a pretty healthy 0.4% bump. Instead, they got nothing. And a flat number like that, well, it's a huge signal that the economy might be a little weaker than people thought, that shoppers are starting to pull back.
Okay, and this is where things get a little weird, a little counterintuitive. On Wall Street, they have a saying for this: bad news is good news. So why on earth would that be? Well, it's because a weaker economy makes it way more likely that the central bank is going to step in and cut interest rates to try and juice things up. And for certain parts of the stock market, lower interest rates are like rocket fuel.
And you can see the market reacting in real time. Look at this. Bond investors moved instantly. This chart shows the yield on the 10-year U.S. government bond. It's a super important benchmark for interest rates, and it just plunged to a 4-week low. That's literally the market pricing in right then and there the hope for future rate cuts.
So this big shift in what everyone thought was going to happen with interest rates, it did more than just move bonds. It kicked off this massive reshuffling of money inside the stock market itself. There's a name for this phenomenon, and it's called market rotation. Basically, investors started selling one type of stock and immediately buying another, all because of that one little piece of economic news.
In that rotation, that's the thing that created the massive divide we saw in the indexes. It basically drew a line in the sand. You had your clear winners for the day, and you had your clear losers. And it all boils down to which kinds of companies really benefit when interest rates are expected to fall.
All right, so on one side, swimming in red, you've got the tech sector. After this huge run, investors just started cashing in their chips, especially in semiconductor stocks. Plus, people are starting to get a little nervous, wondering if all these AI companies can actually turn that hype into real profits. Then on the other side, in the green, you've got what we call value and defensive sectors. Think about companies that sell stuff we always need, food, medicine, plus banks and utilities. These more traditional, steady companies start to look a whole lot more attractive when it looks like rates are headed down. To really get a grip on what this rotation looks like, we don't even need to look at the whole market. The entire story of the day, really, it can be boiled down to the tale of just two very different companies.
Okay, so on the losing team, you have S&P Global. It's a data and analytics firm, kind of tech adjacent. Their stock fell because their earnings report just didn't convince investors that their AI strategy was going to lead to big money. The market wants proof now, not just promises. And then on the winning team, CVS Health. It's a classic defensive stock. Their stock rose because they beat their profit forecasts, driven by just solid, steady performance in their pharmacy business. So you've got high-flying tech facing scrutiny versus a stable value company that suddenly looks really appealing.
And boom, that brings us full circle, right back to our original puzzle. The reason for the big split is all about the DNA of the indexes themselves. It's about what they're made of. The Dow Jones, it's just packed with these value and industrial companies, exactly like a CVS. The Nasdaq, on the other hand, is overwhelmingly dominated by technology and growth stocks, like S&P Global. So that market rotation we talked about, it simply favored the kinds of companies in the Dow and punished the kinds of companies in the Nasdaq. Simple as that. Okay, so that's the story of what happened and why it happened. But the big question is, so what? What does this all mean for you and your portfolio? Let's break down the key takeaways.
All right, first up for you short-term traders out there, the big message is to be cautious. There's more key economic data coming out this week, and it could easily swing things right back in the other direction. Now, if you're a long-term investor, listen up. This could be a signal, maybe the start of a period where those stable, high-dividend value stocks start to shine. And finally, for everybody, this is a big one. The rules have kind of changed for AI stocks. The era of just having a cool story is fading. The market wants to see the money now.
So that leaves us with this one giant question, doesn't it? Was this just a one-day blip, a temporary detour, or was this the first tremor of a bigger earthquake, a real shift, where traditional value stocks finally take the crown back from high-flying tech? Well, only time will tell. If you want to stay ahead of big market shifts just like this one, you know what to do. Hit that subscribe button. Thanks for watching.